Hello everyone, my name is Manvi Walia. Welcome back to my channel where we break down complex financial concepts and make them easy for everyone to understand. If you have been following along, you know we have already covered the basics of financial statements, but today we are going a step further. Now that you know what financial statements are, why they are important, and their key components, let's deep dive into the concepts that will help you analyze these statements like a pro. We will be talking about financial ratios, the cash flow statement, and more advanced topics. So let's begin with something very useful in financial analysis. Financial ratios. These ratios allow us to dig deeper into the company's performance and financial health. By analyzing them, we can determine how well a company is doing in terms of profitability, liquidity, and solvency. Let's start with profitability ratios. Profitability ratios help us to assess how well a company is generating profit from its sales and assets. For example, the net profit margin tells us how much profit is left after all expenses, taxes, and costs are deducted from revenue. Let's take an example. If your bakery earned 1 lakh in revenue and your net profit is 30,000, then the net profit margin is 30%. This means for every 100 rupees in sale, you are keeping 30 rupees as profit. Next, let's talk about liquidity ratio, which show us if a company can meet its short-term obligations. Liquidity ratio, like the current ratio, measures a company ability to pay its short-term liabilities with its current assets. A current ratio usually indicates that a company can cover its short-term debt. For example, let's say your bakery has 50,000 in cash and receivables and your short-term liability are 40,000. Your current ratio would be 1.25, meaning you have more than enough asset to cover your short-term debt. Now, let's move on to the solvency ratio. These help us understand the long-term financial health of the business. Solvency ratios such as the debt to equity ratio help us understand how much debt the company is using to finance its operation compared to its equity. A higher ratio might mean the company is taking on more risk. If your bakery has 2 lakh in debt and 4 lakh in equity, your debt to equity ratio would be 0.5. This means for every 1 rupee of equity, there are 0.5 rupee of debt. Now that we have a good understanding of ratio, let's move to a financial statement that often get overlooked but it is crucial, the cash flow statement. The cash flow statement. It is a powerful tool because it shows you how cash move in and out of a business. Unlike the income statement which shows profit, the cash flow statement shows the actual cash available for your business. The cash flow statement is divided into three main sections. First one, operating activities, second, investing activity, and the last one, financing activity. Let's discuss about operating activity. It shows how much cash is generated or used in the core business operations like selling products or services. For example, if your bakery earned 1 lakh in sales and paid 60,000 in expenses, your operating activity will show 40,000 of cash inflow. Let's now move to investing activities which track cash used for buying or selling long-term assets. Investing activity include cash spent on buying equipment or cash earned from selling assets. For example, if you purchased a new oven worth 50,000, that would be recorded as an outflow in the investing activities section. Lastly, let's talk about financing activity which deal with how the company raise money. Financing activity include cash received from borrowing or cash paid for repaying debt or distributing dividends. For example, if your bakery took a loan of 1 lakh to expand it, it would be recorded as an inflow in the financing section. Now let's discuss an important concept that will help you understand the timing behind the financial statement. Accrual accounting versus cash accounting. Accrual accounting is used to recognize income when it is earned and expenses when they are incurred. not when cash is actually received or paid. On the other hand, cash accounting recognizes income and expenses only when cash is received or paid. For example, let's say you sold cake today but the customer will pay next month. Under accrual accounting, you would recognize the sale today even though you have not received the cash yet. Now let's discuss an important concept that will help you understand the timing behind the financial statement. Accrual accounting versus cash accounting. Accrual accounting is used to recognize income when it is earned and expenses when they are incurred, not when cash is actually received or paid. On the other hand, cash accounting recognizes income and expenses only when cash is received or paid. For example, let's say you sold cake today but the customer will pay next month. Under accrual accounting, you would recognize the sale today even though you have not received the cash yet. Now that we understand the differences, let's take a look at how to prepare a balance sheet, a crucial financial statement. The balance sheet shows a company financial position at a specific point in time. It lists asset, liabilities and equity. The balance sheet follows the equation asset equals to liability plus equity. Let's say your bakery has 2 lakh in asset, 50,000 in liabilities and 1 lakh 50,000 in equity. This balance sheet show the company total assets are financed by 50,000 in debt and 1 lakh 50,000 in owner's equity. Now that we have covered the balance sheet, let's talk about something that often confuses people: depreciation and amortization. Depreciation is the allocation of the cost of a tangible asset over its useful life, while amortization is similar but applies to intangible assets like patents or trademark. Let's take an example. Let's say your bakery buy a new oven for 50,000. Instead of recording the full 50,000 expenses in 1 year, you would spread it out over the oven's expected useful life, let's say 5 years. Finally, let's discuss how financial statements help determine a business value and the role they play in decision making. Financial statements are key to business valuation and help investors, creditors, and managers make decisions. For example, investors use the income statement to assess profitability, while creditors use the balance sheet to assess debit risk. Now that we have covered these advanced topics, you have the knowledge to analyze financial statements and understand their significance in decision making. To summarize, today we have learned about key financial ratios, how to analyze the cash flow statement, the importance of accrual versus cash accounting, and much more. I hope this helped you get a better understanding of financial statements and their importance in business. If you have any question or suggestion for future video, feel free to comment below. Don't forget to like and subscribe.